And joining us now to break down how you may be able to right-size that risk is iCapital Network's Chief Investment Strategist, Anastasia Amoroso. So thank you for being with us this morning. And Anastasia, over the last 10 years, I don't think the 10-year has been above 3%, but it's screaming towards that mark right now. And as you're writing about this morning, at least in your notes to us, you're saying there is starting to be an alternative to stocks. So no more Tina, what are we seeing here?
Yeah, that's right. I think this changed drastically over the last really quarter or so. I mean, if coming into the year, if we looked at the yield on high yield bonds, for example, it was about 4%. It is at 6.5% today. If you looked at the yield on leverage loans, so floating rate securities, that was closer to 5%. Now that's close to 7%. So all of a sudden, we're in this environment where it's really hard to call the direction of the market. It's really hard to call the direction of the economy. So people are looking for certainty. And I think increasingly they're going to be looking for yield. So while there was very little yield to be found in fixed income to start the year, that has changed drastically. And that's why I say there's now an alternative to equities in some ways. And also, if you think about going into an environment where the economy might be a little slower and the outlook for equities might be a little uncertain. Oh, and by the way, we have not priced in a recession. What might you do to de-risk the portfolio? And I think some investors will consider shifting a part of their equity allocation to these, higher risk, but also higher income reward opportunities in fixed income, like high yield and leverage loans. So that's why I say there's an alternative. And Jared, there's other ways to look at the relative value of stocks versus bonds. And if I look at the earnings yield on the S&P 500, but by the way, the earnings are being downgraded, but the earnings yield versus the 10-year treasury, which, as you mentioned, has surged a lot this year, that relationship today, that differential is below a 20-year average. So it's just really, the landscape has changed quite a lot for equities this year.
Do you think the markets should be starting to price in a recession?
Well, it's probably a little bit premature at this point, barring a big risk-off event. And this could be further escalation in Ukraine. This could be an overly hawkish Fed. It could be something else that could potentially push us into a recession. But I do think that we need to be very kind of clear-eyed about this, and that there is a consumer slowdown that is already underway. So it's not to say that equities are going to sell off 20% because of that, but it is to say that the returns from here are likely muted. But the risks that I mentioned, such as overly hawkish Fed or further escalation in Ukraine, I don't think we can rule those out, which could potentially put us into a recession. So for that reason, I don't think you sell all equities and you go into a defensive mode as you try to position for a recession. But I think you think about how might you lock in some of the gains that you've had in the equity markets and add some downside buffers to your portfolio in the event that the base case of no recession near term turns out to be incorrect.
And Anastasia, can we break down what you're thinking along some sector lines, some style lines? Because it's been a very frustrating year for investors. Unless you were in energy stocks, not a lot else has been working consistently since the beginning of the year. So just wondering what you're taking a look at here.
Yeah, I think that one of the most important things investors can do right now is get paid while they wait, while we wait out this volatility and this uncertainty. And so I do think that dividend paying stocks should be a core part of the portfolio at this point. And, that's going to break down across different sectors. You're going to get some energy in there because those companies are paying a nice dividend. You're going to get some healthcare in there as well. And so as a result of focusing on the dividend yield, you're also going to get high quality defensive names in the portfolio that I think can be thought of as a core. Now, if you de-risk a portion of the portfolio, then you can potentially take a little bit more risk somewhere else. And throughout Q1, I've been talking about using the dip that we've had in Q1 to actually add incrementally to some of the technology shares, like software names, like cybersecurity names that have profitability today, that have cash flow today. So I do think you get to have this barbell approach of getting paid with dividend paying stocks, but also taking a little bit of that growth risk, not a high multiple growth risk, but high growth and lower multiple in tech. I think you pair that together. The sector that I would probably avoid at this point, and many investors actually they've been selling it quite severely, is consumer discretionary stocks. If you look at the consumer discretionary, if you look at the consumer-led slowdown, you're already starting to see negative earnings growth that's being penciled in for this year. You're starting to see profit margins that are below 5-year averages right now, which is not the case for all the other sectors. So I would focus on high dividend yield, on high margins, which is healthcare and technology, and I would avoid some of the slimmer margins that you have in consumer discretionary.
Yeah, just taking a look at consumer discretionary, down about 12% on the year. Always appreciate you stopping by. Anastasia Amoroso, iCapital Network's Chief Investment Strategist.